I'm Larry Walther, and this is PrinciplesOfAccounting.com, Chapter 6. In this module, we will look at the bank reconciliation. Now, bank reconciliation is helpful to identify errors and irregularities, as well as adjustments that are needed to the cash account to bring it up to date. The reconciliation should be prepared by an independent person who is not otherwise involved in recording cash receipts and disbursements. This is an important separation of duties control feature. The reconciliation is useful to compare the amount of cash reported in the general ledger to that that's shown on the bank statement. The bank statement is the document that's received periodically from the bank, showing the activity to the bank account, the deposits and withdrawals from that bank account. The amount in the general ledger usually differs from the amount that appears as the ending balance of cash per the bank statement. Let's consider why that's the case. First, there are items on company records, things that have been recorded in the general ledger that have not yet been captured by the bank. To look closer at those, let's think about deposits in transit. A company might make a deposit at the bank. Perhaps you've seen a sign that said deposits made after 3 p.m. will not be posted till the next day's business. Well, that deposit would be debited to cash in the company's general ledger, but it might be a day or two or maybe even lapse over a weekend before it's recorded or processed by the bank and reflected in the bank statement. A similar item, but in an opposite direction, are outstanding checks. These are checks that are written by the company, delivered to a vendor, but not yet deposited by that vendor perhaps, or maybe they're out there in the float. Cash has been removed from the company's general ledger cash account, but not yet removed from the cash account on the bank statement. Finally, there's items that are reflected on the bank statement that may not yet be recorded by the company. These would consist of things such as NSF checks or not sufficient funds checks, or you may know them as hot checks. We deposited a check but it bounced, so the funds were removed from our bank account by the bank. We may learn of that when we prepare a bank reconciliation. The bank statement may reflect bank service charges, or the bank might have collected a note that we left at the bank for collection. Those funds maybe have now been posted to our account. This may be our first learning of it when we look at the bank statement and the bank reconciliation. The bank might have posted interest earnings to our account, and now we're learning about that in the reconciliation process. So, the bank reconciliation is really a dual task. One is to reconcile the balance per the bank statement to the correct amount. The other is to reconcile the balance per the company records to the correct amount. So here's a format for doing that. On the left-hand side is the first reconciliation that takes us from the balance per the bank statement, $50,739 in this case. It adds back deposits in transit and similar receipts entered on company records but not yet reported on the bank statement. And it deducts outstanding checks and similar disbursements entered on company records but not yet reported on the bank statement to arrive at the correct amount of cash. On the other side, we take the ending balance per the company records, $47,535, assuming that's the amount in the general ledger, and we add back interest and similar receipts that are reported on the bank statement but not yet entered on company records, and we deduct NSF checks and similar disbursements reported on the bank statement but not yet entered on the company records, and we should find the correct balance. And the correct balance should equal, that is, the bottom reconciliation on the left should equal the bottom reconciliation on the right. Now, importantly, journal entries must be prepared for all items identified in the reconciliation of the ending balance per company records to the correct cash balance. We need to debit cash for things that suggest an increase in cash and credit items that suggest a decrease in cash to move us from the balance per the company records to the correct amount of cash. This is an important reason for doing a reconciliation. So here's an example. This again is the same reconciliation we looked at a moment ago. And notice that the cash on the company records, $47,000, needs to be increased by $4,968 to reflect the correct amount of cash. And so we'll prepare a journal entry debiting cash, reflecting the increase in this case for $4,968. In turn, we'll record debits for expenses. For example, in this reconciliation, I assume there was an electronics funds transfer to pay a utility bill of $109 that the company had not yet reflected on their books, hence they need to debit utilities expense. There were NSF check and NSF check fees that totaled $462. We're going to try to collect that from our customer, so we'll debit accounts receivable to reflect our intent to try to go back and make the customer make good on that hot check. We have service charges at the bank, and so we'll record that as a miscellaneous expense. Also, the credits here reflect a credit to note receivable, for the note collection along with related interest on the note of $450 and other interest that was posted by the bank of $119. So here we have a balanced journal entry to reflect what caused the $4,968 increase in cash. And so importantly, the reconciliation not only tells you the activity to cash and brings you back into synchronization with your bank's records, but it also provides a data entry point for updating your cash account in the general ledger.